Good afternoon, Scott Redler, T3Live. Welcome to, I don't even know what edition this is of the Q&A on Stocktwits, and have to apologize. It was definitely a long day.
Very long.
As long as it was, and as quiet as it was, there was so much action, so we just like to, rub it off. Anyway, yeah, loosen up a little, Vicki. I'm here with Vicki. Brittany is out today, so she's coming in to help out and help moderate. We're just going to get right to the questions because a lot of people are definitely a little spun around with the recent action that we've seen in the market based on the headlines out of the summit today, based on the quarter end. So we'll just get to it. Just make sure they keep coming in, and we'll get to as many as possible. And I do apologize because Vicki tends to mess the names up. No, it's really easy to. Anyway, you guys have some fun.
All right. Well, the first one's easy. It's from Market Picker. Since the easy bounce has already happened at 1309 in the S&P, would you be looking at the 50-day moving average as resistance 1 and the 100-day as resistance 2?
All right, well, that's a good question. We always talk about the easy part of the move as well as something that's a little bit more difficult to reach based on some levels need actually real conviction versus whether you're just oversold or overbought. So a lot of people said, oh, you were saying to take profits at 1360, 1363 ahead of the Fed. How did you come up with that area? So if you look here at the chart, there are easy areas to try and short. And if you look here, if you remember the head and shoulders top, that's the left shoulder, the head, the right shoulder. This is where we broke down from. So, this area, I wouldn't say was an easy area to short, but it was a nice targeted area to reduce longs, get short. You had the Fed meeting, and then lo and behold, pow. You had a nice potent down move that the bulls definitely weren't happy to see, but you were okay if you reduced your positions based on a move that we just had that it was about 100 handles long. So with that said, you're talking about the easy bounce. So at this particular point, this 1306 to 1309, you guys are probably sick of hearing me talk about it, but it's a point of reference that has made you money if you traded against it. If you recall, once we had that move off the lows through the 200-day, this is the area that held. This is the area that created this right shoulder with the depth of about 30 handles, which also gave us the measured move to 1360, the first part of what could have been this inverted head and shoulders pattern to give you the full measured move all the way up to what could be about 1380 or so. So with that said, again, good area to take some profits. So now what's going on here? We're at, we're bouncing up this 1306, 1309. People are unsure whether it's because the quarter is coming to an end, some window dressing, some shorts worried that something could happen out of the EU. But for right now, all you have to do is trade against it. So at this point, you have this as support, and now you have some defined resistance as well. So you talk about the 50-day, will this be resistance? I do think so. You look at the potency of this wide range bar. We always talk about, which way is leading the tape, and this potent down move is what gave us another directional bar into that support. So now, with a bit of time underneath our belt, we are now going sideways. And at this point, if you were short, saying we have to break 1309, I think you'd feel a bit uncomfortable if we start trading above this 1330, 1337 area for a move to then people will be looking at the 50-day at 1340, and anything above that will start to negate this wide range bar and the actual potency of this directional move, and then you have to just be a bit more flexible.
Okay, and then 767 Driver wants to know, why did the market turn up and go vertical at 230 today? Can you help me understand this one?
Everybody loves to know the why. The question is what happened, how did it happen, and how did you respond to it? Now, I was definitely a bit short this afternoon because high beta looked like crap. Banks were still weak. Everything just looked somewhat broken, but in the back of my head, I'm like, you know what? The EU is still speaking. We're still in meetings, so something could be planted, something could come to help fuel a short covering rally, which, could, rightly so, considering who knows what's going to come out of there tonight or tomorrow. And then also, again, the forces of will probably want some kind of decent close tomorrow in order to get paid on what has been still a decent year. If you talk about percentage gain, the NASDAQ I still think is up 10% or so, or maybe a little less, and the S&P's up 5 or 6. So if people are still long, they still want to protect their gains for the first half of the year to show them, making some money to maybe get paid for their half-year bonus or whatnot. So for guys that trade actively, you need to simplify that. What you do is, I'm sure everyone has different charts up. I actually have a 3-minute chart, I have a 15-minute chart, a 16-minute chart, a daily chart, and what's good to watch over the course of a day is that 3-minute chart because it shows you the trend of the day. When the trend changes, you're not always asking why, you're looking at the what. So if you go here to the chart of the spiders, I will show you that, first of all, again, this has been an area that's been holding this 130.85 zone, good to trade against. You go to your 3-minute chart, and you will see that here you go. Okay, so this was the gap down. Let's go over here. Gap down early on, couldn't trade back into the gap. So the rule is typically if you can't take back a big portion of the gap within the first hour, typically you go in the same direction of that. And yes, we made new lows. Wasn't a lot, but we made new lows into important support. And then, what you do is, as the afternoon progresses, you draw a downtrend line. You draw a downtrend that's controlled the tape for the day. And from this peak here, all the way down throughout the course of the day, you made money shorting into the rally. Shorting into the rally. Shorting into the rally. And then once, a lot of people came in and tried to short these lows here, okay, basically, and we didn't go lower, uncommitted shorts then say, oh my goodness, maybe we don't break today, maybe they mark them up, so they get a little worried. Okay, so then what you want to do is you want to see for the first time when it doesn't work, if you short this 3-minute trend line and it breaks above it on a micro level, you get out. And this is basically when I covered my shorts in the spiders, or maybe I think it actually was a little bit further. Oh, whew, look at that. I think it was somewhere around, actually no, it was right here. This is when it traded above and everyone's like, where's your stop? So I put my stop across. I went vertical. Is that vertical when you go across?
Horizontal.
That's horizontal. Which way is horizontal?
Horizon, vertical.
Oh, that's a good way to remember it. Horizon, vertical. Okay, so anyway, let's go back there. Everyone knows, my grammar and a few other things might not be the sharpest, but here you go. So it broke above here, so that gave you your first flag, like, oh my goodness, what do I do here? This was my cover. So at that point, I got out of the way. It wasn't going to work. We weren't going to break the lows. But I didn't flip long because I really didn't believe in it. Some guys who were actually waiting for this, because there were guys in our community waiting for this to happen because they're like, what, the fix is going to be in. And they're going to dress these things up and make them look pretty, maybe with some lipstick. But you'll know what happens when you put lipstick on a pig. No kidding. Anyway, what was her name? It was Palin. Anyway, okay, so here you go. So from this point, pow, look at the size of this move. So everyone was looking what came out, what came out, what came out. I don't care what came out. It could have been they said Merkel, canceled the conference, blah, blah, blah. Could have been that Germany scored a goal. Could have been that, someone pressed the buy button. But this was your spot to say, you know what, the short might not work. If I'm uncommitted, if not looking to stay with this for the next week or two, this is my out. And if you're looking to get long, this was your spot that you knew that people would squeeze. And then you also had another spot. Here's your gap. Once you get into a gap, that gaps tend to like to get filled, and that gave you, some follow through. So all in all, it was definitely hard to gauge whether or not, what it was, because everyone was looking around. But I'd rather see you just act and not look, because by the time you look and say, what happened, where did this come from, what's the news, is it out of EU, is it out of here, is it out of JP Morgan, what's the size of the loss? P.S. There was a downtrend. You could have maneuvered and stayed out of the way and covered some shorts and also made some money if you were looking, to find that kind of move into the end of the day, which I missed.
Okay. Well, summary there. Gilgal Markets wants to know, what do you think of the Goldman short call of the target of 1285? Will the market go up from here?
Okay, so what do I think
of the contrarian?
Well, you can't just say whatever Goldman says. You got to do the opposite, because they have made a lot of money in the past. They used to have really good technical calls and good long-term calls. Sometimes I don't understand what they're doing. I remember that oil call when it was at 140 a barrel. I was getting short oil, and they said it can go to 215, and it went to 148 before crashing, and I was like, what the hell's the matter with those guys? And then also, this year at 14.15, they said it was a generational buy, and at the point the market was acting okay. It was actually no, actually was a little faulty, and I was saying also, I think maybe 3 months before, saying within the next 3 years, I think that the S&P and the Dow could make new highs, and I'd rather see you long the market than out of the market. But 2 days after their call, it could have been one day that was the top of the market. Then the same way, when we were all looking to see what could happen down here, if you go to the chart, I remember right around here, they said they downgraded the market and said it can go to 1160. You had one more day, as it was a fake out below the 200 day and a reclaimed, and that was the bottom. So I think their market call for a generational buy, I don't remember exactly where it was. It could have been right here, before that, or it might have even been like right around here before this. So with that said, they did actually come out with that call right when the S&P and the spiders were coming into this area. So at least, what they could have said is, they said sell some strength, and which gave some people some caution. So not a bad spot, considering that at least they weren't cheerleading to buy the market here after a 100-handle move. So I thought that was a little bit more prudent. So that's why I wouldn't just go against it. At this particular point, we came in, we went as low as this 130.85, which is that that 61.8% retracement. So if you put up your trusty retracement rules, you will see that we did hold the 0.618% right here, which typically is the last line of defense. So right now the market's holding the last line of defense. So at this point, I think you can't just be a stubborn short and just say, it's going to get there, it's going to test the lows. I would say wait for the market to break this area, because if we get some news out of out of the summit that seems to be like joint debt sharing, fiscal integration, euro bonds, you're going to see a squeeze above this small little downtrend. The same way I showed you the 3-minute downtrend, we're now trading. We have a somewhat interim downtrend. If we get above, then all of a sudden, this is that next level line in the sand, and then if that gets negated, this power is gone. But if we stay below this, and the longer we stay below this, the chances are this floor gives out, and then we could test that area that they were saying. So for right now, I think you have to be more neutral instead of like, I'm a little bit more neutral negative versus neutral positive. So at this, I do think that it could happen. You can't rule out us going to 1285 or rule out testing the lows at 1266, but at this point, I don't think you could be very, very short based on some of the headlines that could hit tonight, tomorrow, as well as new money flows coming into the beginning of what was the third quarter. Because if you remember last year, they squeezed the market all the way through July 4th before going back and testing those lows. So you have to measure your risk tolerance if you could stay with it.
Okay, and sticking with the markets, MKT 2012 wants to know, is the inverse head and shoulder pattern still valid, or has it failed?
I think it's still valid, okay? And just like what I just showed you with the retracement rules, IBD put us back in market correction, which that means you're not supposed to own any stocks, or you have only a long-term horizon with the best of the best, which is what I agree with. But if you look back at this pattern, I think that they usually do 3 distribution days. They change their big picture after 2, just because of the time frame that we're in the market. So if you remember, I said 2 things have to happen for the total inverse head and shoulders pattern to be complete, because you don't always get follow through, like major follow through. And that's why when we hit this area, I said reduce longs, because there are 2 steps of an inverted head and shoulders pattern to meet its measured move. And one step is the depth of the right shoulder. The depth of the right shoulder here was about 3 points. So when it broke above this neckline, you got your 3 points. That's why it was a good spot to reduce longs, because up here, if we would have held, went sideways and stayed there, maybe if the Fed would have done something a little bit more aggressive on that Wednesday, who knows, we could have stayed intact, and then you could have had your completed move, which if you go from 128 to about 133, then 120, 133, you go up about 6-7 points. That gives you the 138, 139, which was really the completed move. You needed something to help it, not just hopes of stimulus, hopes of whatever it is, quantitative easing. You needed good news, and we had a lack thereof it. So I think we were lucky to see that. So with that said, we pulled back in, retested a line, have some support right here. I do think that there is a small chance that this holds and potentially we do get here, but I'm not putting too much money behind it, just because I do look at the action of high beta tech, and to me it looks a little bit faulty. I'm looking for leadership, and I don't see any. I see some rotation into some of the weaker groups, and I just see lethargic, no momentum. So I think you had to be happy with what you got from that 100-handle move off the lows. Happy that you got the intermediate target. At this point, I think the jury's out on whether or not that measured move gets reached or we retest the lows. So, you have to be neutral and just play it by ear here.
Okay, sounds good. I guess let's take a quick commercial break while we wrap up the market summary. So.
All right, sounds good. We'll be back.
Hello, everybody. My name is Pete Renzulli, Chief Marketing Officer of T3Live.com. and one of the traders in the active mentor room for T3 Trading Group. What I'd like to do today is I'm really excited about introducing you to and inviting you to the first T3Live Active Trader Summit in New York City, which is on Saturday, July 14th. We're going to have quite a few speakers today. There's going to be myself, Mike Lee, Evan Lazarus, Mark Sperling, Rob Smith, Rick Meadows. There's going to be a ton of great content, but the number one reason you want to come is you want to be able to network and associate with other like-minded people like myself. I'm going to pump you up. I'm going to guarantee you that. Other people like yourself who have a burning desire to learn how to be a trader. So I'm going to ask you to make a trade. Trade one Saturday for some of your time to come down and learn strategies, tactics, techniques, and put some faces to the people that you see in the virtual trading floor in T3Live, and learn to take your trading bigger. Learn how to be a better trader than you are now. Learn the strategies. It's going to be a lot of fun. I can't stress that. I know it's a Saturday, but you know what? I want you to be there, to get excited, and to be here. Prove to yourself how bad you want it. Show up and come down and get excited with us. Saturday, July 14th. Now, very quickly for the registration. All you have to do is register at T3Live.com or be an existing member of T3Live.com, and you get 2 complimentary admission tickets for free. So all you have to do is go to T3Live.com and register. If you would like to join us at the post-event cocktail reception, you can also upgrade to either premium or VIP. That's up to you, but either way, please take advantage of the general admission, 2 free tickets. Bring a friend, bring a neighbor, bring a wife, bring a girlfriend, maybe bring both, but come down and expect to have a great time. Saturday, July 14th, here in New York City.
Okay, welcome back. Let's go into some individual stock plays and see how they're looking. Leveco wants to know about the LinkedIn chart. What do you make of it if it holds 100?
Okay, what do I make of it? It depends also on what you're looking at. When we talk about some of these names, we talk about whether your time frame is a macro time frame, meaning you're holding stocks longer term. You know, you want to manipulate them as far as a tier system, tier 1, 2, 3, based on chart patterns, or you're looking at day trade, you're looking for momentum, and you want to like love them and leave them. So with LinkedIn, I still think this has macro ingredients for you to hold it. But if you tried buying it yesterday, like I did at 107.15 and got a little bit hurt for a momentum move, you know, you had to get stopped out. So the rule I have is when you play a stock for a momentum move, if it can't hold above that momentum level, you leave. So if you take a quick look at LinkedIn, you will see that overall, technically on the chart, it's been acting very well. So if you go to the chart, you will see overall, you know, that this was a new issue, came public way back when, and you know, it's been under accumulation for almost a year now. It's holding above all the moving averages. They've had 2 quarters in a row that they beat the street, so institutions are getting a little bit more comfortable with them. But on a short-term basis, you know, this was when I think guys who were in a macro tier, because it never went below, you know, it held the 100-day. We talked about stocks that kind of broke below the 100-day, came back above with the best acting stocks. It also never went below the 200-day, and typically our rule is you break the 200-day, you don't take it back within 2-3 sessions, you get out. So anyway, this was, if you were still in tier 1, here is when a lot of guys got into tier 2 when it broke this small little downtrend. Okay, or if you weren't in tier 1, this was a spot. So then after that, you saw it go sideways. It was flagging, it was hanging in there, getting people very excited that if the market got stronger, this would be a leader and it could break out for momentum. So if you look here, look at all these highs here. You have 107.10, you have 107.10, you have 107. So now, Vicki, if you were short LinkedIn and you just saw the market rally, what level would you give it to before you would cover if it was in that flag type formation?
I mean, if I was long it?
No, if you were short it.
Oh, to 107.
107, 107.15, because that was a recent high. So you probably you stayed in the short too long and said, okay, that's my out, because if it gets through 107 or 107.15, it could go to 110, 114, 119, because those were the next levels. So with that said, that's why that becomes an important action area, because shorts are short against it, and anyone thinking it goes back to the highs, which the market's not strong enough for that, that's the level of entry. So with that said, you go back to the chart, stock tried to break above this momentum level. Shorts really didn't get scared because they didn't believe it. Buyers didn't have commitment to say it's going to go to 110 or this area. If you look at this area, this is 114. That's why we talked about 114 as some type of resistance zone. So it traded through it and failed. So for me, I added to it through 107.10, 107.15. It only went as high as 107.82. Really, micro scalpers made a little bit of money in that move as they sold into that. But guys who were trying to get more, like me or Mark or some of the other guys, got a little hurt with it. So people are asking me, where's my stop? I said, you know what? I think 106, if it can't hold 106, that means it's not ready to break out. I'm going to stop myself out. So if you were playing it for momentum and got out 106, today you weren't quaking in your boots when it went down to 101.06, down another 5 points, or you weren't in pain, or you weren't in jeopardy of jumping out of a window if that's what you would do with a stock 5 points against you. Because if you're that scared and that worried about a stock $5 against you, you are not a macro investor, you are not a swing trader, you are an active momentum trader. So when momentum leaves, you leave. But if you are a macro investor last time here, some of you said, okay, it's not ready yet. You go back to the chart. I'm not going to get my immediate gratification. So all in all, it's still above the 100-day. It's still above the 200-day. It's still above this breakout area. It's still acting fine. It's just not rewarding breakouts yet. It's not letting momentum happen. So for this particular point, maybe you're only in tier 1 as a macro investor, holding for the long term for what could be. If you go to your monthly chart, you will see, you know, it's acting really well. It's holding near the highs here. You have a nice big flag type pattern. So it's trying to work off this tail here. Remember that earnings tail? It's holding the top, you know, I would say third of this overall range. So if you're looking at it this way, it still looks very good. Here is where it broke this little downtrend, holding higher, absorbing. And at some particular point, I do think this stock is in the game for much higher prices in the next few years. So as a macro investor, you can stay the course.
Okay. Let's go to Priceline. T-Ling wants to know, what are your thoughts here on Priceline's weakness?
Well, overall, I have a pretty tough time trading Priceline just because of the way it moves and how wide it is and the lack of liquidity sometimes. But off the top of my head, I know that Apple couldn't have any momentum in the last few days. I knew that Google was a little troublesome. In my head, I see Baidu was breaking lower, one of the worst high beta names for now. Netflix obviously has been broken for a while, so right away I probably think to myself on the daily chart, Priceline probably tried to rally and failed. So if you go right here to the daily chart of Priceline, you will see that, you know, let's take a quick look here. You know, this broke below the 100-day and then reclaimed it. I remember it being on some of the price point sheets right here because you did have a tradable pattern, which was nice, right? It came off the lows, held higher, nice downtrend. We like trading against downtrends because when they get broken, you get a move. So anyone who shorted this area got paid. Shorted this area, got paid. Shorted this area, got paid. But as it tightened up, I was like, you better not go to the well one too many times. So PS, once it closed above this downtrend, it gave you a tactical move from this high here of like 655 up to almost 675. So 20 points for a nice tactical trade. And then what happened? It got controlled by this moving average. You know, momentum started to leave the market. This is probably when we failed around 1360, you know, almost right where it broke down from. You know, if you remember when it broke down right here. So it retested that, and now, you know, it's coming back to this support. I think if you're trading this for momentum, you're probably not in there. To me, it looks very sloppy now. It's not tight like it was right here. And, you know, as long as it stays above this, just say 633 and goes sideways, it's still considered a stronger stock, but it's below the moving averages. I do think this could be one of those stocks that changes character in the next year or so, and not say it turns into a Netflix or it turns into a weaker high beta name, but the valuation is rich. I think some of the shorts are starting to win. If you have huge profits in this thing, take them, and just make sure you don't fall asleep behind the wheel here, because this is one of the stocks that I think could change character like we've seen in some of the other names that were strong for the past few years that went from a strong uptrend to what an intermediate downtrend or even worse.
Okay, and the market picker wants to stick with Priceline, and if he was short this, would 625 be a decent target on a short?
Depends where he's shorted from, but if you take a look here, I would think that some people probably covered their shorts into this support. This is probably an objective that I would have been looking at, the 630. Let's take a closer look here. You will see that you have some guys who probably shorted some of the strength, and then you saw this wide range bar move to the downside. This is where it broke out from. So it really couldn't get back above it. So you had this little inside range right here. It broke below it, but it just went from just say 680 actually, or even a little bit more, down to his low today of 633. So this bigger support, just like you have that same support of 1306 to 1309 the market held, it's probably going to have to go sideways a little bit here. I would say if you have some room, give it to this. Make this your stop. Your stop right here could be 660. And if it can't get back above that and hovers, or maybe can't even get back above this and stays in the bottom end of the range, if it breaks this, you're going to get more than 625. You're probably going to move down to this 600 area. But I have a feeling not much is going to take place until earnings come out, because we're going to start entering earnings season in the next few weeks here. So those are the levels.
And then O Canada wants to know your thoughts on IBM as it tries to hold the 200-day.
My thoughts on IBM. It's kind of interesting because for traders and investors, things are different. And if you were with me in the first quarter, you know that IBM was one of those 10 to 15 stocks that I held. There was a nice breakout area. It wound up going from, I think we were talking 194. Let's see if I remember my head, 194. What was that level that we always had in IBM?
195, wasn't it?
Yeah, 190, somewhere like
50 to 195, I think.
Yeah, Vicki does a lot of the off the charts work with me, so I remember doing that. But when it happened, it went from 194 to 199 through 200 to 204, 207. And then it got a little faulty. I'm like, you know what? I'm done with IBM. And as a trader, it made sense. And I know it went a little bit higher, but who cares? The chart pattern wasn't tight. So now if you look at IBM now, wow, not saying that was, let me just show you the reason why, like what traders like, okay? Go right over here, just real quickly. Remember when it was right here? If you were, trading with us and you were there early, you saw, move to the highs. It was holding up here. This is when the market looked good. It was still in February. We're looking for a breakout. So this was something that we were watching. So tier 1 in here. Tier 2 was when it broke above 194, 195. And then our target was somewhere like 204 or so. So if you look what happened here, boom, look at that nice wide range bar. And then remember, it held here again for a little bit. So we were staying with it because there was tradable patterns as a trader. So here's your flag pattern above this nice horizontal consolidation right in front of a 52-week high. Another tactic that we love. And then pow, look what happened from there. Whoops, let me get you the pow. There's the pow. Boom. Okay, nice move, hugging the 8-day moving average the entire time. And then it started to change. Okay, this is, I think, when we got out of it. It went a little higher. Who cares? Okay, but then actually went a lot higher. Went to almost 210. And then once it broke the 8-day moving average, remember we were talking, as long as the market holds the 10-day moving average, everyone's spoiled, stay with it, it broke. This is when we got out of it. And then that's, I think, the last time we really traded it. So fast forward, a lot of choppy mess, noise, the whole spiel. It's below the 200-day. If you're still in it, I think that you stay in it. But you know me, when stocks start to break the 200-day, and if they can't take it back very quickly, I think it's a time to sell. And I've been looking at stocks that are very heavy on revenues coming out of Europe or even from the public sector, and I think both of those are going to be problem spots for a lot of companies moving forward. Europe is going to go through austerity. There is going to be a slowdown. They're not going to order as much stuff. And IBM, I know, is big in Europe. Also, they're big in the public sector. And we have our own little deficit problem, our own little debt ceiling problem. So this is something that I thought in my head that probably would get weaker, and it has. Same way some of those cloud computing names have gotten really crushed. We haven't spoken about BMW in a long time, right? Rightly so. Look at what happened here. Okay, this was your shooting star top. Never reclaimed it. Broke this key level here, and you haven't heard me talk about BMW in a while, and now look. Stocks leave the price point sheet for a reason. And the cloud computing arena, is very prone to the public sector / Europe, and that's the stocks / groups that are going to hit the most. So just be a little bit careful, with those stocks, and do a little bit more of your homework and know where the revenues and net income are coming from.
Okay, let's go on to one of your favorite stocks, Apple. MSQB1 wants to know, last year Apple made a 25% run into July earnings. What kind of chart setup would you look in order to get long this stock?
That's a few different questions. Every year is kind of different. And I think this quarter for Apple, I'm not going to get into what I think their earnings are going to be. I kind of think they're in a little bit of a soft spot. People are probably waiting for iPhone 5 to come out. You had iPhone 4, 4S. So if you had the 4, you might not have upgraded to the 4S, or if you did, you're probably not looking to get a new iPhone until you see iPhone 5. So that could be a little bit of a problem spot. I also know that, you using the Warren Buffett method, I don't remember the last time I bought an iPod A lot of people are using their iPhones as an iPod. I know I run with my iPhone, you know, and I use it for that. And then I also have an iPad. So, you know, unbelievable growth company, but I think that this quarter you have to be a little bit careful. Lately, the stock itself, which I follow the technicals, not acting as well as it should. You know, the last 2 days it was very lethargic. I tweeted about it. I talked about it. I'm like, you know what? We just had a 2-day bounce in the S&P, and Apple couldn't go anywhere. There was no volume, no interest. So today it actually traded a little bit lower. I know Vicki, once it failed at that 590, you know, you put that ascending channel, and as a short, what price was the short that we had on off the charts?
I think like 580-ish.
580-ish. So, you know, there's some room to make money on the short side tactically. So if you look at the chart now of Apple, you will see, you know, it's kind of wishy-washy. Last time I had a good long here, I think there were 2 tactical ones, was when it, you know, broke above or bounced off the 100-day, gave you a nice move, and then failed, couldn't break out. And then if you remember the event, the all famous event, that's when you had another outside day where it tried to break through and failed right there. So that was a little bit of a sell signal. Then there was another tactical good trade. And we talk about hitting singles over the summer, you know, because doubles and triples are hard to find, and you had a nice little buy here. We did this again. Then I remember, you know, I lost a lot of money right here thinking that it was going to break above this 590, help lead the market. And if it did so, we probably would have went above 1360 in the S&P, but this gave you some signals that that was going to contain it. So question, I guess, right now is where are we? This time, you know, we held the 100-day by a thread. You know, last time we bounced real hard off it the next day, so let's see what happens tomorrow. You have a small little downtrend right here. I know if I was short Apple, which I'm not, if it started breaking above, just say this 576, I would be a little worried because there's, you know, room up to about 590. So this would, I think, if you're trading it tactically, look at this small little range developing here above this 576. It could start going to the upside once again. But if it doesn't start getting away from this area, away from, you know, this somewhat of a, you know, it's already broken a little bit of this ascending channel here, which I think this is where you had the 580 when it broke right here. This was the short point. You know, nice little tactical thing below that 580. Boom, it went to almost 566 today. So here's another point of reference. So trade versus level. Watch today's low. Today's low was, let me get off there. Today's low is 565.61. So see how it goes. But if it starts breaking below this and the market starts falling apart, next big support doesn't come to about 550. And then obviously these lows right here. So we shall see. Right now, Apple's not leading the market. And anytime it doesn't lead the market, it's prone to some kind of weakness. Same way we saw that at 620. Very similar. I remember when the market bounced back and Apple didn't go anywhere when the S&Ps made that lower high. We just had that 2-day bounce back off of 1390, off of 1306, 1309, and Apple did nothing. So at this point, if you're in it for a macro hold, stay with it, be in tier 1. If you're trying to tactically trade it, keep taking your trades, because if you add to it as it's going higher, you'll lose money. Today, if you were short, you made money, but if you tried shorting lows, you probably gave back your profits. So at this point, expect less, take less, and just let it add up.
All right. Sticking with like momentum stocks, Birdie JC wants to know, is LULU still a good short at this point, especially off of the Nike earnings?
Oh, it's probably going to be down off the Nike earnings. And I tweeted actually today saying, if you've been short LULU, good spot to cover some and then trail some. That's a statement I always say, because that's part of our whole mantra with the tier system, is book some, save some. Book some, trail some. So this way you could feel good, put some money in the bank, but also stick around for what could be a little bit of a better move. And LULU started changing character, I think, 3 months ago almost. And Vicki, you've had that in off the charts a few times, even before the faulty earnings.
Yeah.
And so it gives you some signals. And a lot of these rich in multiple stocks, they're priced for perfection. When they start to slow down a little bit, if it lines up technically, you have to lighten up. And if you look here on LULU, you will see, I hate this, okay? I hate when you have a stock like this that looks like it's going to break out for momentum and comes right back in. To me, that's a false breakout. That's always a sell signal. Okay, and then what happened here? It couldn't get back above. Went lower, broke this area. Okay, and then what did it do? It pushed back up into the base, made a lower high, and then look at this outside day right before earnings. So if you're a trader, you didn't take it into earnings anyway. If you were looking at this faulty type action after a huge move it's had for multiple years, you probably should have sold some or hedged some into earnings because you never know. So anyway, with that said, we talk about gaps, we talk about pro gaps, we talk about the 200-day. So look what happened here. Stock gap down, and obviously from here all the way down here needed some time, had some follow through, came back up, and could not fill this gap. So nobody thought that Lulu's on sale. Look, somebody who had it here at 69, now I could buy it down here, was in a rush to buy it. So that showed you some technical weakness. Then you overlay a price point right here. A lot of guys, once it's crossed below this level here, which was 62.80, that was your tactical short for day traders or momentum traders or whatnot. And then today, it traded below this previous low area. Some people said it was rumors. Some people said they heard Ihorn was shorting it. I just think it's been technically weak and broken. So what did it do? It actually filled this old gap. That's why you look longer term or pretty damn close to it, right? Came in, went to almost a gap fill. The gap fill was right here at 54.08. It went as low as 56, so $2 from filling the gap. So anyway, with that said, Nike's down like 10 bucks, I think. That's where it was before I came in here. I would say cover some, use this now as your next point of reference, and just keep trading it. But if you go to your weekly chart, you will see it still has a long way to go. It looks like it just pulled in a lot. Look where it was in 2009. Look where it is now. If I just try and draw somewhat of a trend here by using my ruler, well, here is when it first tried to break, I guess, and couldn't, and then held this support, and now this most recent, I guess, run from here is kind of coming into in an area. So just like using my little crayon and chalkboard, this was the last time it started to break out again. So this is going to be a crucial area. If it doesn't bounce off of here, and this is also where it broke out from, on this little downtrend. So on a macro level, you look over here where it's coming into. If this doesn't hold, you could see a move to this moving average, which should be pretty painful, which is about another 10 points lower if you're a macro investor.
All right, we're going to take a quick commercial break, and we'll be right back with more questions.
Hi, I'm Sean Hendelman, CEO of T3Live, where we train, coach, and mentor traders to understand how to develop an edge in the markets so you can put your money to work with confidence. The T3Live approach includes a mix of training, trading, and technology to help you learn to recognize, adapt, and ultimately take advantage of different market conditions. So what actually separates T3Live from other educational firms? For one, transparency. We show all of our positions live, so there is no smoke and mirrors. Basically, we put our money where our mouth is. We have to because we're regulated by the SEC and the Chicago Board of Exchange. Number two, we're real traders. You'll be learning from real professional traders that make a living trading their own proprietary trading accounts, not just instructors that don't trade. Your goal should be to associate and learn from big traders who can teach you how to take your trading to the next level. And three, credibility. Millions of people turn to places like CNBC, Wall Street Journal, Fox Business News, and these outlets actually look to T3Live for information. No other educational firms are asked to be a consistent contributor. We at T3Live would like to get you started with a step-by-step method that has been proven over time. The same blueprint for success that I've gone through. It's not a weekend seminar, it's an approach, a mindset, a process to show you how to take control of your financial future. To begin your training with T3Live, we would like to offer you the opportunity to enroll in our Foundation 30-day online home study course. The reason I'm willing to give you such a valuable course for free is I'm sure that once you complete the program, you'll want to continue your education with our team. All you have to do is fill in your name, email address, and I'll see you on the other side.
All right, we're back with some more questions. Chart Girl NYC wants to know, what do you think of JP Morgan's action today after the news?
I think everyone who woke up earlier in the day pretty much thought to themselves, what's going to happen with JP Morgan? $2 billion to $4 billion to maybe $9 billion. Because I remember being in here, I think it was, I didn't even remember, like maybe a month ago when people were like, what's going on with JP Morgan? What's going on? I'm like, well, it closed below the 10-day. It didn't act well today. It could be lower after hours. And meanwhile, that's when they made the announcement and it got crushed. And since then, it wound up making its low right when they actually announced that it was going to be $4.2 billion versus $2 billion because it was priced in and it was oversold. So if you go to the chart, you will see that down here, this was the day that they announced the first part of the loss, which was the shocking portion. Okay, but it wasn't really a shock because a lot of guys got out of this. Remember, we were hovering and holding the 8 and the 20-day moving average, and then once we curled below it, a lot of guys started getting out anyway. So I don't think anyone was caught in this, but no one expected it. So PS went all the way down. I remember this day was down pre-market, and I said, and that was right when we were near the lows in the market. I was like, you know what, if JP Morgan wants to price in, or the market wants to price in the news and buy the news, because you sell the rumor, buy the news, it could also help the market. So PS, it was a nice Bible situation, gave you 2 days, then it held higher, had a small little downtrend, and since then, had a nice rally back to retest the gap. Okay, at that point I figured it would need a rest anyway. So with that said, today I talked about 2 levels that should be watched. One was 35.50, which I thought was too aggressive to hold. I'm like, why would it hold 35.50 if it's a $9 billion loss? Look at this bigger support in this area. You can look at the chart on Chartly, and it wound up holding, 34.85 right in front of the 34.64. So all in all, I think it took the news in stride. If you look at your Fibonacci retracements, which we also had on there, and you go across to this little peak here, you will see that it pretty much held, like where the market came in and held this 0.618% area, JP Morgan held higher. So the banks are acting a bit better during this bounce that we've seen in the market. It's also, so it's held above the 0.382%, which shows you commitment. So all in all, I think that this was very constructive for guys involved with JP Morgan. You also had a midday news/announcement, because JP Morgan didn't say that their loss was going to be $9 billion. There was reports saying it could be up to $9 billion. So then all of a sudden midday, which also helped, I think, propel the market higher, there was some reports saying it might only be $5-6 billion. So it's so funny, the difference between $2 billion, $4 billion, $6 billion, $9 billion, a lot of money there. So anyway, you go to the 3-minute chart to see what happened here, and it was a good trade because a lot of us caught that trade, including me, even though I didn't take that much out of it. So we talk about downtrends, and when they get broken, if you go from the peak of the morning all the way down, this is when JP Morgan broke its downtrend. I think right around here is when the news came out, actually a little bit before then. I remember buying right around this 35. I think was that it, right around there? Yeah, something like that, right around here. And this was also, look at the downtrend. Downtrend was broken, so once it failed here, it came in. You could have shorted against it, shorted against it, shorted against it. Then the news came out that it was probably going to be $6 billion. So if you were short, you were a little worried. $3 billion less in the morning report. And then from here, I think I caught like 30 cents in it because I was actually thinking short, so I was just happy to have a long there. And then once it broke above this level here, it started to really move, and then it actually went into the gap, which shows you that the gap didn't have as much power, the downside gap. So to me, it looks as if JP Morgan is acting much better, and then you can continue to buy the dips. That the move from 46 all the way down to here has priced in a lot of this bad news, and then we'll see what happens during earnings. And I think they're somewhere in like 2 weeks from now, like maybe July 14th or so. So at this point, I would say trade it long versus this 34.60 area, and then with time, with some sideways consolidation, we'll get some kind of momentum trade above this 36.82 into the gap. So all in all, I think it helped the market today. And if you were involved in JP Morgan, you had to be happy with the way it reacted to this further depressing / negative news.
Mm-hmm. All right, we've got a couple questions on executing and indicators and stuff like that. So USA Wild says that he relies heavily on Elliott wave, fib patterns, support resistance, blah, 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 uses several time frames, and he wants to know any advice on all this.
My advice is not to use too many indicators, not to have one indicator that negates another indicator. Don't look for the perfect situation. What I like to do is at different stages of the market, I use different indicators because the market's changing and some things are important at certain times. And if you remember, during the first quarter, when we were able to have a multiple portfolio approach or multiple stock approach, I said, as long as we keep following this 8/10-day moving average, why get out of your stock? So that was very important. So once we broke the 8-day or the 10-day moving average, they held the 20-day twice. So those were very important at the time. Then once we got into the end of the first quarter, when we said take a step back. That's when I had G-Toy on here, the GOAT, and we're like, you know what, switch gears. We just had a huge move in the first quarter. We can't expect that for the second quarter. So let's take it as it comes, not knowing that we'd get the huge decline. That's when the head and shoulders pattern, blah, blah, blah. Then all of a sudden, when things are coming in, then other moving averages become important because you want to see what holds higher. And when the S&P came down to hit the 200-day, if you recall, the strongest stocks that acted the best only came down to the 100-day. So that showed you relative strength. Stock that holds higher versus where the market goes lower are go-to stocks that act better once that market bounces. So it was important to know what stocks held their 100-day. They became the go-to list once we bounced off and reclaimed the 200-day in the S&P. Now, as far as Fibonacci retracements, I just showed you on the market where it was important to know. If you go back to the S&P, you will see that we talked about levels to measure the speed that you have to get back in. And there are two ways to do the fib, which is one from the bottom to here to measure where we could potentially bounce from. And if you look here, the 61.8% sort of worked to cover shorts, maybe play for a bounce, because I showed you, way back when, I don't know what report I did it on, but if you guys remember, okay, this October 4th reversal low that happened in October, and by the way, I want you to take note here. Look how many times during this summer, okay, from August all the way through, you had this monotonous, crazy range where if you paid the highs, you were hurt. If you shorted lows, you had no follow-through. So just to keep that in mind when you think you're going to get any kind of follow-through coming into July 4th weekend. So anyway, from this low here, you had a move, right, all the way to the highs. And what held? The 61.8% retracement. So I said the other day in the morning call, I'm like, you know what? Even though the bulls are a little bit upset and the bears are probably shorting here because they think it's not going to hold, it could hold. And that's what happened here, back in November. And then you had another move. And then I said, again, let's use our Fibonacci retracements to measure the speed. And then if you go from here to this high, what held this time? Oh my goodness, what a coinky-dink. The 61.8% retracement. So held here, continued, held here, continued. So that's why we didn't lose faith this time, saying that, we might have retraced more than we thought, but we still held this 61.8% retracement. So if you did short here, kind of cover, get a little flexible. Now the only caveat here is it's coming into July 4th, so I'm not really I have such conviction that this is going to stick or this is going to stick because we have so much summer ahead of us, okay? We have all of July, all of August. You have the mudslinging that's going to go on, which we started to see today with the healthcare reform bill, where they all of a sudden now saying, it's a tax on the middle class. So they're going to just start beating each other up and dragging us through the mud. And then maybe some of the emphasis will come off Europe because we do have a spending problem also and a deficit problem, but we haven't really been in the news because Europe's been 10 times worse. But anyway, back to the indicators. I like to put myself as like a cocktail napkin technician where I don't use too many indicators. I like to use chart patterns, nice tight patterns, so I know defined resistance, defined support, so I could trade a breakout, short a breakdown, use Fibonacci levels when they are necessary, use moving averages based on the composure when they're riding them or whether they're pulling back to see where the strength is. And then intraday, you could really even simplify it and say, okay, I'm trading a stock. Futures just went up and my stock didn't go up. So what does it do? It's acting poorly, you short it. Futures go down, your stock doesn't go down. It's acting well, you buy it. And then put obviously a 3-minute chart and some other things in there. So keep it simple. If you put too many indicators out there, you're never gonna pull the trigger. And just get comfortable and rely on a set of them that works for you, because different indicators work for different people based on their time frame and their risk tolerance.
Okay, and then sticking with trading, Yes You All wants to know, what do you think? Yes You All.
Yes y'all, where are you from?
Wants to know, what do you think of trading Max Pain?
Max Pain could probably put you out of business. People are in max pain based on a scenario that's happening that is unexpected, that is blowing out volatility, that is trading people through what has been, just a situation that no one expected. And same way you go to I hate to say, you go to a casino and you're walking through a casino, you see a huge just a crowd around the roulette table, and you see 12 reds on there, and everyone started coming over saying, you know what, I'm going to take the pain of the table. People started at 6 reds, 8 reds, 12 reds, they're all going for a black now. and they think just because there's 12 reds on the table that maybe, you know, 14, 15, or 16, there's going to be a black and you play for it, then all of a sudden 20 reds happen and people are mortgaging their house and losing their credit cards because, you know, it really is one is independent of another, but that's just a situation. So what I like to do is the max pain trade, everyone loves it. They think they're going to get rich, you know, playing against everyone's pain. It doesn't work because it could blow you out of the water. Because you might think the fourth day up is a spot to start, and then it could be up 8, 9 days or the same way to the downside. It could be 7, 8 days down. So that's why we created the red dog reversal. So at least you're not doing the max pain trade. You're trading a level versus a level, which is the same type of scenario. It's a way to play a counter trend move, but at least it's calculated. You're not just cost averaging into shorts that can continue to Pluto, or cost averaging in longs that can go to zero. So anyway, with that said, you know, like Facebook is a good example of, you know, using not max pain, but having a strategy. And if you go to Facebook, you will see, you know, a lot of people thought, you know, here what the IPO was, you know, it opened at 42. You know, I could be buying it at the new issue price of 38. And then look what happened. It went all the way down to 32. Then they said, okay, you know what? I think it's going to hold 30. I'm pretty confident. People are paying 42. I'm going to pay right here. Okay. And, you know, they got involved here, and all of a sudden we started breaking below this level. So now we're breaking below 30.94. And first of all, you haven't seen a reversal pattern yet. You had a one inside day, big deal. So if you started buying here, it was very hard to accumulate, thinking that at this point everyone's starting to talk about 16, 17 for Facebook. So what we waited for was a red dog reversal. Okay, this was the first time it did it, where it made a low, broke below this area of 27.86. Okay, went as low as 26.83. So when it recrossed this area, you then bought it. You had a $1 stop, and it closed well. You made almost $1 in it, and then this could have been the reversal. It could have been, but it wasn't. So, you know, you always take a little bit off at the end of the day. I remember being involved, and then I actually got out a little bit early, but typically you put your stop right here because you never know. Again, you start doing max pain. We could have went to 17, 16, 15. That's what people were saying. So anyway, here you go now to another spot. Now you're at 25. We went from 42 to 25. This one wasn't as extreme as this red dog reversal because it was so beaten up. This time it went through 25.75, which was the low. Okay, people said, oh my goodness, it's going to the low 20s, let me get out because I'm probably experiencing max pain as I've been just buying this whole way down. And then what happened here is it didn't go below, came back above. You could have rebought it, you know, for the first time when it went back above the 25.75 low. Okay, then you had your stop. This one was even tighter, 50 cents. Here was $1, and then it never violated this area. So on this reversal pattern, you know, you had a good entry. Then you had this lower pivot where this is where I think a lot of guys made even more money because it started to stretch. When it went above 28.10, we tweeted about it. I'm like, yeah, I'm taking it. And P.S., you had a nice move up to 34 or so before now, you know, breaking, showing a little bit of off the charts. We had it here. The underwriters came out and they didn't give it a hurrah, or maybe the media. P.S., you know, this was probably a way to get out right there. So without having to take max pain and have a calculated 20-cent stop, you could have rode this thing from around 25.75 all the way up to 33 and made yourself a lot of money. You know, here you might have lost $1. Here you made, you know, almost 5 or 6. So there's a way to not put yourself out of business by using a reversal strategy versus cost averaging up or cost averaging down. And it's not necessary, in my opinion.
Okay, sounds good. That's all we have time for today. But thanks for having me again.
All right, well, Vicki, thanks for moderating. Today is Thursday. I don't think you guys should be going out for a happy hour and staying out to all hours of the night like I'm going to do. No, I'm kidding. I'm not doing that. Anyway, our traders are going to Stone Street. So if you're in the city and you're hanging around and you want to come meet us, we're going out for happy hour. It's a beautiful night in the Northeast. But we're going to keep in mind that tomorrow, last day of the quarter, you also have some news coming out of the EU summit. At this point, I think you could be neutral with no opinions. You know, your support is 1306 to 1309. You know, your resistance that we could squeeze above is around 1337. You know, just be flexible. We have a lot of summer left, a lot of headlines in front of us. I like to hit singles over the summer, let them add up, have limited stress, go out there on the bike, train. The Ironman's in 5 weeks from now, so we're going to start documenting that process if you have any interest. I also, I didn't talk about this before, but last week we gave out a month free of Off the Charts. And I'm being told from the producers inside that we could do it again. Okay, so what you need to do is go info@t3live.com and put in, OTC, which stands for off the charts, and there's no obligation, no money down, no nothing, and you'll get a month for free off the charts, which is one of the products that we love. And basically, Vicki helps me out a lot with that. It's a great tool. It comes out at night. It gives you the composure of the market. We talk about stocks that are trending that you could get involved in and not be a professional day trader. Or, you could just do it for cash flow. It reiterates a lot of the tactics and strategies that we teach in our active trading course. So if you take our active trading course, you will understand why we have certain stocks in off the charts. So the better you understand why we're putting them in off the charts, the more conviction you'll have to act on them. So there's a puzzle that needs to be put together. So at this point, if you want off the charts, go to info@t3live.com. I hope I'm saying it right. It's on the front page. And we'll give you a month for free during the month of July, so you can have some good reading material while you're at the beach or at the summer stage or enjoying yourself, however you want to do that. And that's it. I'm done.
All right. Have a good night.